Welcome everybody to Module 4 of our Strength Matters Bootcamp. Today's presenters are the same as the last few modules, Gail LaCroix and Scott Siemens. Thank you both for being here and for all your work on developing this curriculum and continuing to refine it as we go along. So those of you who are seeking CPE credits, please make sure that you submit all polls, including the final evaluation. We use the polls and also the Zoom attendance record to make sure that we have documentation that you've participated fully through the session. So in order to get your CPE credits, we need to have both of those things in place. And in the final evaluation, you'll see that there's a place to request your certificate. If you need an interim certificate for license renewal purposes or any other reason, just send me an email to let me know that. Related to the CPE credits, if you see that your display name in Zoom is just showing your first name or is not showing the correct name, please send me a chat message to let me know what name should be showing up there, and I can fix that for you. If you have any tech issues during the session, and especially if you're seeking CPEs and you have a hard time submitting polls, just send me a chat message right away, and that will serve as documentation for your participation at that point. You can use the chat to also submit any content questions for the presenters. We will pause to answer questions during the session. While presenters are speaking, we will have everybody muted and you'll be put into a breakout room for an exercise later, and you will have the chance to unmute, and also we encourage you to turn on your video during that time as well to participate in that discussion with your peers. So I'm going to go ahead and end my share and pass this off to Scott to control.
All right, let me share my screen now. And let me catch up with you. All right, hopefully everyone can see that now. So as usual, we're going to kind of recap what we've covered in the last few weeks. Again, working our way chronologically through the life cycle of a typical affordable housing project. We started out in the first module by talking about some of the early funding that usually comes in to your agency and how to account for that early on in the deal cycle. Then we moved the next week into the choice of legal entity. How to decide whether to use a nonprofit, partnership, LLC, et cetera, to house legally the housing. And then last week, we talked about the actual deal structure for a typical LIHTC deal. So we're getting more specific now into low-income housing tax credits, which will be kind of the focus for the next several modules. Although many of the concepts that we're talking about accounting-wise relate to any type of affordable housing development. So it could be a HUD nonprofit ownership structure or local state agency. Accounting is pretty similar, but we're really going to be speaking really from the standpoint of a LIHTC, low-income housing tax credit project, just because those are the most predominant one, most predominant financing structure that you run into these days. So today, module 4, we're going to be talking about financial projections, which are, you could think of that kind of like the prospectus that gets sent out to the potential investors. You've got a large pool of ready, willing, and able investors out there that want to get involved in tax credits because it's a win-win for them and you and society as a whole. So the projections are the way that you can kind of communicate to them what they're getting into in terms of credits, losses, et cetera. And then we'll also cover letters of intent, and that's where you're really getting the deal points nailed down. The investors are describing all the specific requirements that they would impose upon you, and you can then maybe make a better informed choice as to which investor you want to go with. You're going to be married to these investors for the next 15 years, so you want to make sure you make a good selection up front. So before we jump into all that information, let's start with a poll. So I mentioned that projections are the kind of the operating pro forma shows the next 15 years of profit and loss, income and expense, tax deductions, tax credits, that type of information. The investors require to see something like that so they know what they're getting involved with, what they're purchasing, in effect, with their contribution. It also has a construction budget, and it shows the sources and uses. So it's like a matrix that shows which funding source is going to pay for which construction use during the development period. So question for the poll is, who prepares those projections at your agency? Is it prepared internally by your accounting staff or your asset managers or your developers? Or do you use an outside consultant for development consultant, or some combination of all of the above? Or maybe you don't know because you haven't been involved with that. And the most popular choice was a combination of the above. And that's pretty typical because what we see a lot is that there's a third-party financial consultant involved that actually owns the Excel template that's used for the projections. But of course, they cannot, complete that information in a vacuum. They need to work with your development staff who obtain all of the pricing information for how much the different costs will be, what it is you're going to be building. And asset managers get involved in the 15-year projections, the cash flow. Often these projections will show the surplus cash each of the next 15 years, and then the waterfall of how it's going to be distributed. The accounting staff will be needed as well to determine, what the income and expenses will be each year based on budgets and assumptions. And it is probably a combination of all of those people working as a team that ultimately create those projections. That's what I see most often.
Yeah, and it is really important that it be a combination, because I've been with agencies when I arrive and the asset management staff were not involved in the operating pro formas, but yet they get held accountable for them. So that's not really very fair. If we're not budgeting enough for snow removal up in the Northeast, you can be really slammed. And remember, your development staff just want numbers that make it look good. They want the pro formas to be something that the investor is going to accept. And sometimes they lack a little reality. So not wittingly or knowingly, I don't mean to suggest the development staff are trying to do something on purpose, but they don't operate the property. So they don't necessarily think about all the operating costs. Really, really important to have whoever's going to be overseeing the operations to be involved when you're projecting the operating costs.
That's an important point, because quite often the investor requires what they call an indemnification, which is basically a guarantee where your sponsor, your nonprofit agency, is guaranteeing that you will be delivering maybe 95% of the same credits and losses that you promised on these projections. And so it's not uncommon that as the years go by, maybe the vacancies are lower than projected, in this economy. Maybe you're fully rented. And so although you were projecting a 5% vacancy loss, you end up with no vacancy loss. So now you're not giving them the same tax deductions through the loss that you had promised on the projections. So come 10 years down the road, you may find that you're not meeting the target of what you promised to deliver. And so that's when the tax credit indemnification could kick in, where the limited partner says, well, I didn't get what you promised from the partnership. So now you, the developer, the nonprofit developer, needs to make up the difference, or the general partner in the partnership has to pay us. So it all comes back to the developer ultimately having to fund those. So all the more reason why Gail is emphasizing that you want the budget to be realistic, because you're going to be held to delivering something close to that by the investor.
Right.
All right, let me regain control of my slides now so I can advance to the next one. There we go.
Okay, so I think Scott just gave you a little summary, but the financial projections have 3 key components in them, and you're going to get to see, you have a sample in your handouts. So it will include the development budget, which is all the construction costs, sources and uses. That's a really wonderful place to see the scope of the project in one place. So you want to be paying attention to that. As soon as that comes out, you should be making sure that you're looking at this so that you have some sense of what's going to come in the future. It will also show what they project the eligible basis to be. Remember, we walked through that last time where Scott talked about the fact that the costs that we incur as part of development, the costs that are depreciable, are eligible for tax credits. And so the projection will show what we estimate the eligible basis to be, and then therefore do an actual credit calculation, also projecting what we think we're going to get for the credits. And at this point in time, you are working with an investor or a couple of investors. You do have some sense of where the credits are coming. You know, it is a market, generally speaking, the investors are all within a certain range. You know, you won't have somebody at 40 cents on the dollar and somebody else at 90 cents on the dollar. You might have a 10%, 15% swing between investors. So you do have somewhat of an understanding of what they're willing to pay. So the prelim credit calculation is there, and that's really helpful. And then the operating pro formas are included for 20 years. And so it's important to look at those to make sure they're realistic. They will show you whether we think we're going to have cash flow or not. That's pretty important for you to know whether you're taking on a project that is really doing wonderfully well and is expected to throw off cash, or maybe not so much and it's just break even. So for your cash flow planning purposes, it would be good for you to know when this project comes online. Can you expect to be receiving cash from it? Is it break even, or God forbid, are we close to the line where we might have to subsidize that? So there are operating reserves that are almost always put in place right at the beginning. It's one of the development costs, is one of the sources needs to fund reserves. And so there are operating reserves. Typically they burn off after 5 years if the project in operations is meeting a certain debt service coverage ratio. Nowadays we do see those sunset, meaning that they burn off, and you'd actually be able to distribute that surplus, that operating reserve, if after 5 years you've met the debt service coverage ratios. So that's an important thing. I remember I told you want to try to have a seat at the table. Not all developers look for that kind of language. I look for it because I don't want guarantees of or commitments in my world as the CFO of this nonprofit. I'm always looking to reduce commitments and contingencies, et cetera. So I have a keen eye on how long do I have to keep reserves in place? What's the requirement? Can we make sure that this goes away after year 5? So it's in my best interest to think about those things, and not always do the development folks or the attorneys. They don't think about those either because they're not used to operating the property.
Yeah, here in California, we see most often the reserve has to stay, the funded operating reserve has to stay with the property, so it doesn't get distributed. But we do see the operating deficit guarantee burn off after a certain number of years of positive debt service coverage, as you say. Mm-hmm. So just a difference state by state that you see differences across the country. All right, next slide.
Okay, so we've already probably answered this, so hopefully you all get this right. Who do you think should primarily be responsible for the preparation of the operating pro forma? We're focused now just on the operating pro forma section of the projections. And I think there's probably a couple of answers here, a couple of good answers. It really just depends on your organization and what you staff internally and what you use for consulting capacity external to the organization. So Lindsay, you want to put up the poll? Thank you. Oh, combination. Yep, I think that's the right answer. You know, you really need to have asset management and finance involved. I mean, the good news is you all think that, and that's really important that y'all understand that it's important to have the folks who are going to be operating the property after it's all built and the development folks go away, that they're really involved with preparing those operating pro formas.
All right, so I think we're going to go into breakout rooms pretty soon. We're going to work on an exercise that involves looking at the projections. Let me see if I can pull that up. I think you all have that in your materials, but let me pull it up so you can see what we're talking about.
So this is just gonna get you comfortable with where to look in the projections for what information. So it should be helpful to you going forward so that you'll know where to look. And this format, again, you know, we had to use somebody's format to give you a case study. It happens to be Massachusetts because I put the case study together. But this can, remember that the format could be different in any state, but the component, they should be the same. There should be a development budget. There should be operating pro formas. There should be a credit calculation. It just might look a little different in your state.
So let's see, time-wise, I think we'll spend, what, 10 or 15 minutes answering these 6 questions in our breakout rooms. Then we'll come back as a group and talk about the answers for another 10 or 15 minutes. That sound good? Okay.
Yeah.
Oh, look, they're all excited. I can see it.
Looking for your
I can
materials.
see it on their face. They're like, wow, when can we get to this?
All right. I'm going to send folks out.
Thanks,
Okay.
Lindsay.
I think we're all back. Everyone's back from the breakout rooms. Let's see how we did on the class exercise. The next slide is the answers to the class exercise. So what is the total development cost and the total development cost per unit? Here are the answers. 31,911,000. I think you find that on row 661. I think it was on page 3 of the PDF. So that's the first few pages of the PDF is the development budget. And at the end of that budget, towards the top of the 3rd page, I think it was, you find the row 661. That's the one that has a label of total development costs. So that's the $31 million figure. And I think the very next row, 662, is the row that showed the development cost per unit, which was 393,963. Hopefully everyone got that one. So then the second question, how much developer fee and overhead will be earned? I think on row 659, you see the developer fee, and on row 660, you see the overhead. So it's on the same page, just a little bit higher. And each one was about $1,011,000. You add the two together and you get $2,022,576. So
Scott, I'm sorry, I was muted. Let me just go back to number 1. On the handout, I provided an edit to the document that you can take a look at. The difference between TDC and net TDC takes out the reserves, right? Because reserves are just a bank account. It's not really the construction cost. And it also takes out any deferred development fee, meaning development fee that's not going to be able to be paid from construction sources. And that's, if you take both of those out, you get to net TDC. So I show you that calculation on the handout itself, just so that you understand. Did somebody have a question? Let's just see. I think the comment on the bottom right on page 3. Let me just look that up. On page 3, are you on page 8 of 30 on the document, on the handout? I'm not sure, page, yes, you're on page, so 8 of 30. So that's the low-income housing tax credit calculation. So that's the amount of credit we requested from the state agency. It's not the amount we were awarded, it's the amount that we initially requested. If you multiply that by the $1.09 that the investor said they'd give us for each credit, and you multiply that by 10 years of credit, that's the total equity that investor is willing to provide to the project. and the project uses that as one of its major sources to do the renovation work or the construction work. So you'll see this more clearly when we look at the cost certification, which we will be doing not today, but in the module coming up. You'll actually see this calculation, how the project, where the project ended up. Remember that these are just initial projections. And so the at the end of the project, things can vary a little bit, but you'll see it in the cost certification once we get to that module. Okay, so this is the amount of equity that the investor is agreeing to put in based upon what we estimated we'd get from the state for credits. Does that make sense? Okay.
Okay, so on to the third question.
Yeah.
What is the amount of the annual low-income housing tax credit requested by the project? And I think it's row 1085, which is, let me see, what page is that on?
Yeah, it's on page 8, the page we were just looking at.
Okay, so you see there a line for the low-income housing tax credit requested. There's several lines. One talks about the limit. So I think that's Massachusetts limit. And then there are other rows, but the one that says requested, that's the one that's specific to this project based on the eligible basis estimated in the projections. And so that's the 857, 565, and that's an annual number. So that means altogether, they're going to get 10 years of that amount, 10 times that amount.
Yeah, so that's question 4, and I'll apologize to you. That includes the word annual and it should not. So we're just asking you to estimate the maximum tax credits that would have been requested of the investor. So it's just taking the 857 and multiplying it by 10.
So that's the amount of the credit that will be given to the, provided to the investor. Well, 99.9% of that.
Mhm.
And then I think there's also a field on that same page that talks about the amount that of the proceeds that will be requested of the investors. So that's their capital contribution, in other words.
Right.
So, you might have, instead of looking at the credit that you're giving to the investor, depending on how you read this question, you might have interpreted it to mean how much are the tax credit proceeds that the investor is going to put into the partnership, which is
Right.
the capital contribution. So that would be on row 1089. All right, so question number 5, how much project cash flow is potentially available for distribution in year 5? And so I think we have to now advance several pages. Let's see, what page is that answer on? You can use the chat window to tell me what
It's on page 10 of 30.
Okay.
And I just want to point out, it's not the number on the bottom, which is what I initially thought when I was trying to do this, and somebody else thought the same thing. If you go up a little bit, you're going to see total net operating income. Right. Yep. So Lee, thank you. It's row 1669. So you start with net operating income, you deduct to debt service, and you get to project cash flow. So the last 2 columns really look at required debt service and coverage and how much surplus you had towards that debt service requirement. So it's really 1669. So 177,455.
And then the final question, what is the debt service coverage ratio in year 10? Somebody use the chat and tell us what page we find that answer.
So page 12, row 1718. Nice, Rebecca. Nice, Allie.
Yeah. $1.29, 1.29. Debt service coverage ratio is 1.29. So that's good.
So somebody just asked if there's an Excel version of this. There is not, I don't have it. This is actually a fillable form on the state's website. That goes every time you have to amend it or as you're working on it, it goes back up to the state's website. It's not something that comes to us in Excel. I don't know if anybody else has an example of that. We'd be happy to send it out to folks if somebody else has an Excel version. Yeah, I know, because I think what folks in the last class, they wanted to be able to click on the cells to see what the formulas were. Right? How do we get to that answer? So and in the version that we have, it's just a PDF that came out of the project's closing binders.
Yeah, most of the third-party financial consultants that create these projections as their business line, they don't want to give out the Excel version of those projections because that's proprietary for them. But they will give you a PDF copy. Okay, sounds like we did great on the case study. So let's move on. And if you have any questions on any of those numbers, feel free to use the chat, and then the break that's coming up, we can use some of our time during the break to go over that in more detail.
So
we have
poll 3, yeah. How much was the investor projected to pay for each dollar of low-income housing tax credit received? Hopefully you saw that answer. We just talked about it. And how much operating surplus will there be in year 5? There's no operating surplus. The surplus was more than 50. The surplus was, I'm sorry, less than 50 or more than 50. So in question 1, be sure you're answering for low-income housing tax credits, because this deal had historic credits also that had a different price.
Do we have results for the poll? I guess people have to refer back to the handouts to answer the question, so it takes longer than usual.
Somebody's asking a question about a couple of the lines. If you could stay on after the break, that'd be great. Or during the break, we can walk through that. So $1.09 was what was offered for the low-income housing tax credit credits. 95 cents was what was offered for the historic tax credits. It's just a different type of tax credit that you often see if you have historic buildings that you're working with, which we do here. And operating surplus, I think we determined there was $177,000 worth of operating surplus in year 5. So that would be more than 50,000. Okay, so this is just an individual exercise. There's a letter of intent that's in your handouts. This is something that you should be looking at. It used to be that you would see a lot of the terms of the deal once the partnership agreement or the LLC agreement, operating agreement was formed. Now, almost all of the key terms come in the letter of intent that comes from the investor. So by the time, if you're only getting involved at the partnership level, when the partnership agreement's being worked on, the operating agreement, it's too late, because the key terms were agreed to most likely in this letter of intent. And so now letters of intent are anywhere between 7 to 12 pages long. They used to be a 1 or 2 pager. And I think people wisely decided they better nail down some of the more pertinent terms before we actually accepted an investor. So if you take a look at the letter of intent, you'll see all of the things that we thought about asking for when we went out with an RFP to the investors, and you can take a look and see how they responded. And so this investor, I think it shows you it's Bank of America. So just take a few minutes to take a look at that. There's that operating deficit guarantee Scott was talking about.
And that's where it says it's going to terminate if you maintain 1.15 debt service coverage ratio for within the first 60-month period for at least 12 months. And there's the tax credit guarantee indemnification I was talking about too. Should the actual tax credits be lower than the projected credits, there'll be a downward adjustment.
So if you've taken a quick look at this, why don't you throw some of your answers in chat as to what you think you might be focused on? And there really is no wrong answer here. It's all important. Yep, the waterfall, that's pretty critical. Terms of debt and guarantees, yep. Yep. Right, any guarantees, right, we really want to pay attention to. So if you go back up, Scott, one thing to be thinking about, and your development folks will really think about this. This is a chart that shows you when the equity is going to come in. You know, they have very specific criteria for when they're going to fund you. They don't just give you the $9 million upfront. They make you produce certain things at certain times to get that equity. It's really important to match that up with when you're going to need the money, right? Because if the investor funds you after you need the money and you need to find a bridging source, you need to know that pretty far in advance, or you need to negotiate around these deadlines with the investor. So you can see all of the things that have to happen.
So the big chunk really comes in after operations begins. 9.3 million coming in after you've achieved this debt service coverage ratio from operating cash flow. So most of the money you'll need to build the project will not be coming from the investor up front. It's going to probably need to have a construction loan or a bridge loan to get you through to this time when this final 9 million comes in, then you can pay down the construction loan.
Right.
Meanwhile, you're bearing a higher rate of interest on the construction loan than your permanent loan would have. So you're trying to get to this point as fast as possible.
So how many people think that, so I'm looking this to cash flow, so developer fees, right? That's important that we see the development fee. Right of first refusal provisions, that's critical. That's a very important element of the agreement. That's talking specifically about how the investor gets out of the deal at the end of the term and how you arrange to take full ownership of the deal. That's critically important. Most of our tax folks are keyed in on that and will help us write the RFP. Do you care about how much they're going to give you per credit? Right? It might make a big difference to you if Bank of America is offering you $1.09 per credit and somebody else is offering you $1.20 per credit. That's a lot more subsidy that you could do some things with. So that might be of interest to you, although I would tell you that that while that's important, it's not always the determining factor, and there's usually not that much of a spread between them. Yeah, reserves required $1,000 per unit. It's big. It might be. It depends upon where you're located. So there's lots of things to pay attention to. I guess that's the point. There's a lot of things to pay attention to in here. And I think in your handouts, there's a chart that I've given you that we use. It's just a simple Excel chart that we use that help you compare each investor side by side. You might have 3 or 4 folks respond to your proposal. And so you want to have a vehicle for looking at how they responded so that you can compare them and make a decision.
So I think we might be at a good point for a break, 10-minute break, about halfway through. So why don't we come back at 10 minutes past the hour? And in the meantime, any of you that want to stick around can do so, and we'll be here to talk. Let me see if I can pull up the projections again, because one of the chats asked to go through that.
Well, it's the same lines that we were just talking about. So let's just chat about that. I think you were looking at lines. It's the way we calculate the estimated yield on the federal LIHTC and the historic tax credits. So if we think our project's going to earn, well, you know what? It's not so easy to look at the historic. The historic is not, that calculation is elsewhere. It does not use this formula. So you don't have the information to calculate the historics. It's just given to you here. So focus on the LIHTC units. So you basically taking the $857,000 of tax credit that you requested, that's just a request amount, and multiply it by the $1.09 that Bank of America is going to give you, then the estimated LIHTC, so I don't know what word to use, capital contribution you should expect to receive is $9,347,462. The federal historic tax credit calculation is not here. It's just added to the bottom of this calculation to arrive at the total estimated yield of $9,820,000. And I honestly am not sure where the $11,923,000 comes from. But what's relevant is row 1089, 1090, 1091. Those are the numbers you're going to see come through the cost certification. Does that help? Maybe, maybe not.
Hi, I have a question for you.
Yep.
It's about the developer fee.
Yep.
It's my understanding that any kind of development consultant that you hire has to be paid out of the developer fee.
Yep.
You cannot book for that. So on your spreadsheet, we had a development consultant, cost of $250,000.
It depends on what they're doing.
Okay.
So if their consulting arrangement with you is that of as that of an outsourced development staff person, in other words, doing the things that the development staff would normally do, you're absolutely right. It would have to be paid out of fee. Sometimes we have development consultants that do other things that are perfectly legitimate to include in your projections. There's just not enough information here. I'd have to go back and look and see what this particular consultant did. But that's a very good observation. I think that's great that you observed that, because you could have somebody do projections and try to double dip, and that's not a good thing. So that's great that you picked up on that.
Well, I work on the housing development side, so I've been kind of tuned into that, and I'm slowly moving over into asset management. So that's one of the main reasons I took this class, is because us developers were great at developing, but
Right. But so
there's a lot more to it.
Yeah, there's a lot more to it. And you're the perfect person to understand this. If you're straddling those roles, you'll see this very clearly, that oftentimes there isn't enough involvement by asset management or the operations folks. So it's great that you see it from your vantage point. You're going to have a benefit going into your new role.
Right. And one of the key things I'm now trying to do is to pull finance into these projects much sooner than we have in the past.
Right. That's great.
Because there's such a coordination that has to be done between all people.
Right. That's great.
Thank you.
Any other questions we can try and tackle during the break? All right, it's 10 minutes past the hour now, so let's get back to this module. I think we have a poll question. What amount per credit are you seeing paid by investors on your deals? We saw in the case study, it was $1.09 per low-income housing tax credit. So are you seeing under 80 cents per dollar, between 80 and 90 cents per dollar, above 90 cents, or you're not sure because you're not involved with that part of the deal process? This tends to vary based on inflationary expectations because, and also based on investors' desire for yield on their investment of capital in exchange for the tax credits. So because the credits are delivered over 10 years, the losses are delivered over 15 years, various inflationary estimates are involved. Risk is assessed and the investors come up with a range that they're willing to pay for these credits. But yeah, usually it's less than $1. Most of you are not sure, but the second most common answer is 80 to 90 cents. And it does tend to hover around 90 cents, at least in my experience. Lately, it's been in the 90-cent range, plus or minus.
Okay, so we sort of talked a little bit about this before the break. So what is of importance to the developer? If you go back to look at that letter of intent, and you all had some great answers. So you want to look at the price per credit. You want to look at the timing of the equity that's coming in to make sure that you don't have a bridging problem. Certainly you want to look at all kinds of guarantees, operating deficit guarantees, tax credit guarantees, any unusual guarantees that might be in there. It's really important to understand those. And as Scott pointed out in the operating deficit guarantee, you could see that as long as after year 5, we had maintained a certain debt service coverage ratio, and there was a minimum of about $830,000 in the operating reserve, that operating deficit guarantee went away. So as your financial folks, you want to be aware of when those guarantees go away. Certainly you want to take them out of your financial statements so that anybody who's looking at your financials has an accurate sense of what your guarantees look like. Adjusters, that's a fancy word for what happens if you over or under deliver. So when we over or under deliver, we can over or under deliver basis that we use to calculate the credit. We can also over or under deliver on the timing of delivery of the credit. In other words, the project finishes early and we can deliver the credits earlier, or the project finishes late and we're stalled in delivering the credits. The investor cares very much about both of those. And so they will have a section called adjusters where they will adjust the amount they're willing to pay you depending upon what happens, whether you over or under deliver. It's really important to understand those. Timing is usually critical, and I've seen timing be thrown off by weather. They could be thrown off by if you have a union workforce and you have a strike, it can be thrown off for that reason. It can be thrown off for lots of reasons. So it's really important to pay attention to those adjusters. I will say generally we've had positive adjusters, and the investor is sometimes willing to work with you. In one case, we had a negative adjuster. Either we were delayed in timing or amount. I think it was a timing issue, and the investor waived the requirement, and so they did not adjust us downward, which was a wonderful thing. So again, relationship. The sooner you form those relationships, the easier things will go if things go awry a bit. So adjusters are quite important. Timing of the receipt of the development fee, that's critical as the nonprofit CFO or controller. If you're counting on that fee to pay for something and it doesn't come in when you think it's going to come in, that could be a cash flow problem for you. So you want to look at the timing of the receipt of that fee. And if your deal slides, so will your fee. If costs go up and there's no other source, your fee will go down. So it's important to track the project as it goes along if you're counting on those fees. And I would say 95% of you on this call work for agencies that count on those fees. And I think the best practice model, Strength Matters and NeighborWorks would tell you that we should not be counting on development fees to fund normal operating costs because we can't predict them. And but I don't know too many agencies that are successful at that. We all tend to rely on development fee. And then
the reason this comes up here is that the developer fee, most of it anyway, if not all of it, is actually being funded by limited partner capital contributions. So typically the loans don't fund the developer fee, or maybe they only fund a small part of it. And it's the investor's capital that is supposed to be funding the fee. And so that's why Section 10 of the partnership agreement says you can't pay yourself the fee from the partnership until you receive the capital contribution that includes that fee amount. That's what we're talking about now.
Right. And generally speaking, they don't want you to get your fee until you've done everything you said you were going to do. So, and that's pretty fair, I think. But like we said, things can slide. And if you're counting on that fee for cash flow purposes, you got to know that. And then several of you answered in the chat, distributable cash flow. That's absolutely right. Again, focusing on who gets the cash. You know, is the investor looking to get asset management fees, incentive fees, some share cut out of the residual surplus? I mean, that's all negotiable with them in terms of how much they're taking out of surplus cash. If you're lucky enough to have surplus cash, not all of us have that, or certainly not on all of our deals, but it is something to be paying attention to. Reserve requirements are really important. Thinking about what reserves the property is going to have to maintain. Generally, though, I would say to you that that gets thought of and put in the development budget so that those get reserved with sources coming in right from the get-go. I've not seen it where they may want you to maintain a certain reserve level and you might have to fund that from operations if you happen to use reserves, but I've not seen it where operations is allowed to build those reserves up. They actually get funded right at the beginning of the deal. And then somebody smartly pointed out the right of first refusal. Funny to be thinking about it. We're not even in the deal yet. We're just courting the investor at this point, but we still have to think about how to get out. And so that's what makes these deals really not as risky as Scott was explaining. It's because everything gets thought about before the shovel hits the ground. We know how we're getting into the deal. We know who the players are that we're getting into it with, and we have a plan for getting out of it. And so it's really important to make sure that language is there. That is very important in terms of getting out of the deal without there being significant financial consequences. But at this stage of the game, most of our really brilliant tax attorneys who work with us are very competent at structuring that language, and they will be working with you to make sure that you have the right language in your deals.
That's like your prenup. You want to have your prenup written down and signed and agreed to before you get married to this investor, because you know it's going to be a 15-year term, and at the end you want to know how you're going to divide up the assets. So this right of first refusal determines, you know, how the assets are going to be split up at when the divorce happens in year 15.
So somebody asked if the waterfall that we look at it in this particular deal is consistent with every other deal. It's not at all. This is a very simple waterfall. That's part of the reason I chose this case study. Waterfall calculations could be a whole class, and we've talked about putting that together in and of itself. They can be extremely complicated and involve a number of people in the deal that need to be paid out of surplus cash. So there are soft debt lenders in particular, which are state and city lenders, that if there's surplus cash, will request some cut of that. The investor usually gets something, we get something, but you know, it can be extensive. They can be fairly extensive with 15, 16 steps on them, or they can be quite simple. So it just depends on your deal. And we're going to talk about waterfall calculations because generally folks look at the partnership or operating agreement to put their waterfall together. You know, you should have an Excel schedule ideally for each one of your waterfalls because they have different terms. So you would be sort of looking at that and making sure that you have the right terms, but it's not just the partnership agreement that you have to look to. And we're going to actually talk about that and have a class exercise on that. You really need to look at your loan documents. In my case, on one of my transactions, the city actually has its own calculation for surplus cash. And they don't want my calculation, because I had that conversation with them where the calculation for the partnership agreement would have actually paid them more. They didn't want that. They wanted their calculation, and it paid them something less than what it would have been had I put it through our waterfall. So the cities and states can have their own calculations that you need to follow. And so we'll talk about that later, but they can be complicated. I appreciate that question, and because it is important for you to understand they're not always that simple. But hopefully the concept, we'll give you the concepts as we go through the rest of the modules. We got a few more to go before we get to number 11. So hopefully you'll understand more about all the things you need to be looking at to really focus on that.
All right, let me move on to the next slide.
Yeah. Okay, so a couple more things. We talked about proprietary or direct investors. You know, do you want an investor that is direct to you as opposed to a multi-investor fund? That might be of interest to you. It's a lot easier to deal with one partner than to deal with a whole host of investors. I explained to you, do you care about the credit price? Yeah, I think it's something that falls in the mix, but there can be some other things that are so onerous that it doesn't matter to you that they're the highest bidder. So there's a lot of things to consider. Equity installments, guarantees, losses and credits. These are important to the investor. Distributable cash flows, and then reporting. I just want to focus on that because I didn't say that on the last slide. They are sticklers for the most part about financial reporting. They have a lot of investees, and they're tax driven. So they're driven by the tax timing of partnerships being returns being filed on time. And so you have got to adhere to the reporting requirements. They have the right to fine you if you're later than X number of days. I've never been fined. I've been late, but with many emails. Here's why I'm late. Here's where I'm going to get it to you. Usually if you're playing nice in the sandbox, they'll play nice with you, but they have the right to fine you. So reporting requirements are really critical for them in terms of getting tax return filed. You know, if you think about it, the partnership agreement has to be filed with all the K1s, then the K1 has to roll back to the initial investors who then now have to prepare their returns. So there's a whole host or line of players here that really count on this reporting. So it's critically important that you pay attention to those reporting deadlines. That's from their standpoint, and because they take it so seriously, so should you. And then the
later the better is good from your standpoint. If you see a January deadline in a draft partnership agreement, see if you can push that back to April, because that'll buy you more time to get your audits and tax returns done. And you probably have to negotiate that and end up maybe with February or March. But anyway, it's an important point to try to push back, especially in year one, because there you're trying to get a cost cert done. Usually everyone's rushing to move in and get the units rented up by December 31, and then cost certs are starting up in January. And if they have a February reporting deadline to get the audit and tax return done, that's pretty difficult to accomplish. So
yeah, your auditors will be happy if you can push it off a little too, right, Scott?
Yeah, very happy.
Yeah, so I mean, there's a happy medium there about pushing it off. From my side of the house, I like to get it done so that I can think about the current year that I'm in, right? So how many months are you in 2021 and you're still doing 2020 stuff? So from my standpoint, I love if I can, and it might kill me to get it there, but if I can get all my filings done in 2020, early 2021 for 2020, and I can focus on 2021, I think it's a much better outcome internally for us. But I have to be considerate of my auditor's schedules. They can't do everybody first. It doesn't work that way. And so we have to really work with them. And so I will say I do run the reporting requirements by my auditors. I call and say, hey, listen, we're about to sign this new deal. Is this going to be a problem for you? I do think about that and actually have that conversation.
The most common one I see is March 31 for both audits and tax returns.
Yeah.
And that's also the one that HUD has. HUD is a pretty popular lender, and they have a March 31 deadline. Used to be February 28, but I guess they got so much pushback over the years that they moved it about 10 years ago to March 31. So you have 3 months to get your audit done if you're a HUD project. And that's fairly common for partnerships too. But some are February, some are April. So yeah, it's they're all different.
Mm-hmm. Okay.
So now we have another poll, poll number 5. Do you think that the price per dollar of LIHTC should be the most important consideration when selecting an investor? Gail alluded to the answer to this a few minutes ago.
Mhm.
See
Sorry,
if you agree.
having trouble actually getting the poll to show. So give me one sec. Let's see if I can get it. No, I cannot quite get it. Well, I think I'm going to have you guys respond to the poll questions in the chat because I cannot open this poll for some reason. So if everybody could just type their responses into the chat, we'll count that for your CPE credits and we'll be able to see your responses there.
Nice.
We won't get the tally, unfortunately, but
That's okay, but I'm seeing a lot of no's, which is
Yeah.
good, right? I'm
Yeah.
glad. Yep,
That's the official answer.
yep. Yep, so I'm glad you guys are getting the point that there's just a lot of things to think about that are really important for different reasons. And so it's not just the price, per dollar that you're able to sell your credits for. So so this is the chart that I was talking about. Thanks, Scott, for flipping to that.
Okay.
I do not have that. We're working on putting this into Excel, this chart. I don't have it in Excel now. This is a chart that I had from another project where we were looking at equity. Oh, maybe this is in Excel. Maybe we did get this into Excel. Looks like it is. So you should be able to use this. And so you can see that these are the different investors that were approached. So Royal Bank of Canada, Enterprise, Bank of America, and Wells Fargo. So again, these numbers are not going to tie to the case study. This is a different project that this particular chart was done for. So you can see that we just looked through and try to document what the key attributes were for each particular investor. So your organization might use something different, something similar, might not do this at all. It might be a back of the envelope thing. I don't know, you'd have to ask how the investor is chosen. It would be interesting for you to know that. So we do it by a sort of democratic process where the development folks and the finance folks and the CEO of the company or executive director of the company, we in a room, we sort of walk through the options and make a decision. And sometimes it's just the right feel. Hopefully you're interviewing your investors face to face or Zoom to Zoom at these days. And sometimes you can tell that there's a synergy that is as meaningful as some of these financial metrics. Don't underestimate that either.
So it's appropriate on the last poll question about the pricing, because if you look at the different columns here, you see there's quite a range from Royal Bank of Canada willing to pay 97 cents per dollar. Apparently that would yield over $14 million of tax credit equity from the investor if you went with Royal Bank of Canada. And the other end of the extreme is Enterprise, 90 cents a dollar, which is just over $13 million of tax credit equity. So that's a $1 million swing just between those two investors. If you only looked at that one criteria, you'd certainly be tempted to go with Royal Bank of Canada to get that extra $1 million of tax credit equity, which means you have to borrow $1 million less of permanent loan, which may make the project more affordable without having to incur interest on that $1 million of permanent loan that you won't need if you go with Royal Bank of Canada. But the problem is, if you look at some of the other criteria, maybe Royal Bank of Canada doesn't, prevail because there might be something, like Gail said, so onerous in their requirement that you wouldn't want that extra $1 million because the ultimate reality is that there'll be some other attribute that's making life worse for you. That doesn't make it worth it.
So if I remember correctly on this particular deal, we did actually choose RBC, not because of the price per option, but if you, and Scott is actually on the page, if you look at the exit tax strategy, I know it's a little hard to read, but RBC actually waived the payment of exit taxes. So they were willing to pay their own exit taxes, which is not typical. Usually the purchase price to get somebody out is to pay their exit taxes.
So this, I think we might have touched on it in an earlier module, but the exit tax results because the investor's capital, for tax purposes anyway, goes negative. And in order to leave a partnership, if you have a negative capital account, the partnership has to allocate income to you to bring your capital account back up to zero. It's also known as phantom income. You don't get any cash, but if you have negative $1 million of capital, because you've taken depreciation deductions for all those years in excess of your capital contribution, now your capital is negative at year 15, you want to leave the partnership, well, that negative $1 million capital balance has to ultimately come back to zero, because you don't get free tax write-offs without some kind of income in an equal amount, ultimately. So at the end of the day, so this is called an exit tax, because on your final tax return, your final K1 will give that partner $1 million of income. Well, they have to pay tax now on that $1 million. And so if they're in the 21% tax bracket for federal and got a state tax bracket, maybe 10%. So maybe the 30% of that, which is $300,000, is what's called the exit tax. So that's the amount that you might typically have to pay the investor to leave. And if the projections show that negative $1 million capital at year 15, then you know going into it that you're going to have to come up with $300,000 at the end of the day in year 15 to buy them out. So this is quite a nice provision from RBC that they're going to pay their own exit tax, because that's usually one of the biggest hurdles for year 15 is how to fund that buyout. Where's that money going to come from so that you can obtain 100% ownership of this property? So it's great that not only is the highest bidder for the credits per dollar the same organization that's also willing to forego having you pay their exit taxes at the end of the day. Very nice.
Yeah, pretty nice. So somebody asked if the column B was, are the sections in the RFP. They're probably not all the sections of the RFP, but yeah, they should refer to the sections of the RFP so you know where you're looking.
All right, let's get back to our slideshow.
Oh, I already told you the answer. Sorry, guys. Everybody should get this right. You only had about 4 minutes to see that, but it'd be interesting to know if we gave you some time, whether you would have picked somebody else.
%. Picked Royal Bank of Canada, that's right.
Yep, that was who we selected. So, but like I said, maybe if you had had more time to review the chart, you might have chosen somebody else. That would be another interesting, we could do a whole hour on that class, I'm sure. So you made it to the end of our fourth module. Congratulations. The next session, we're going to be talking about new construction rehab costs and something called the funder's requisition. And that's just a fancy word for invoice, the monthly invoice that goes to the people who are providing the funding each month so we can pay our vendors, pay our construction guys and our architects and our lawyers. So we're going to talk about that next session. So hopefully we'll see you all then. That's a 2-hour session on the 13th of October. So I think there's a poll for the class that you need to complete if you're thinking about CPE.
Yep, I just shared that. So folks should see the evaluation up now. And if there are any final questions, feel free to put them into the chat, or you can unmute to ask questions now as well.
Mm-hmm.
Stick around for a while, answer any questions that you might have, and otherwise we'll see you next week for Module 5. Thank you for your attention. Okay.
I had a question. When we were going over the letter of intent, all of those different points, is there a standard on what's negotiable and what's taboo? Or do you just try and go for as many, many different as you can in negotiation?
So I would say that we usually review that with legal counsel. And legal counsel who does affordable housing deals like 24/7. And they, we do 1 or 2 every year, and they do 100 or 200 every year. And so they really have a good handle on what you could fight for and what you should just leave alone.
Okay.
I mean, everything's negotiable, right, at the end of the day, but if there's standard terms that you're just not used to seeing, or I'm not just not used to seeing because I've only done 1 or 2 deals, but the attorneys will be really helpful with regard to that.
Great, thanks.
This is Nyla. I have a question regarding the RFP. We are looking at working with, are establishing a developer partner relationship. And some of the prospective proposers will have their own investors that they want to bring to the table. Is that typical? And if so, then how do you really deal with that? From a standpoint of one developer is just a developer, another one already has investors lined up.
Yes, some developers get used to working with a particular investor, and they use them, again and again. Most developers, from what I see, we work with a lot of developers doing their audit and tax work here in California. Most of them use a variety of investors. I don't know of any developer that keeps using the same investor over and over again. They may, 100% of the time, because they may use the one 50% of the time, but then they'll use other ones the other 50% of the time. So they seem to have preferences based on their experience. They say, we've tried these different investors. We had a really good time, easy time with this one, and this other one we'd never use again because they're so demanding, and what they wanted didn't make sense to us. So, they develop favorites, and they may gravitate towards them. You may find, if you're working with developers, that they may already have a preconceived idea of which investor they like to work with. It's not uncommon.
I have a question on the exit taxes. Does the developer have to demonstrate, how they will raise those funds to support the exit strategy? And is that somehow built into your agreement, or can you just describe a little bit more about how a developer presents their case as to how they're going to pay for those exit taxes?
Well, generally, the developer does have to show some financial capability, not necessarily to pay the exit tax, but just to get into the deal to begin with. So we're often asked as a CPA firm to write a letter or certify that the investor has certain financial strength in excess of X millions of dollars in their net assets, so that it seems like they are financially stable and they can get into the deal. I don't think, typically, I haven't seen the investor ask, how are you going to pay our exit tax in year 15?
But that's right. But that's why, so we talked a bit about this. That's why everybody monitors what's happening every single year so that you don't get into that situation. Right. So if your investor should have an asset manager, and your tax preparers are also watching the deal. And they watch for that. They watch to see if there's a trend towards building up a negative capital account. And they do things to correct that over a period of time. So if you have enough time, you can do things like maybe change the depreciation method. I mean, that might not be the best example, but you can do things. You can allocate more of the profit to the limited partner, right? You can change the allocation methodology. So there are a lot of tax strategies around avoiding getting into that position, because nobody wants to be in that position. If you think about it. So it's only if you're not paying attention that can happen, and you can end up with a serious situation. And in early deals, that happened. I mean, there was a very large court case here in Cambridge, Mass, with a very large housing agency and an investor, where the documents were not written to say that the nonprofit had to pay the exit taxes. It wasn't even considered, and nobody monitored the deal. And at the end, there was a massive tax due. And there was a very significant lawsuit brought by those investors against the organization, and they lost. So it's a defining case for those of us in this industry, that those of us who develop housing have something, have the right to uphold those agreements, and that investors who think they can just push through don't necessarily have that ability. And so it really was something that came to the forefront, I don't know, 10, 15 years ago, where we just needed to do a far better job documenting the provisions of what has to happen. And we had to do it at the end. So right of first refusal language really stepped up. And then we have to do a much better job of monitoring our deals so that we don't get into that situation.
Thank you.
No problem.
Yeah, going back 30 plus years, the exit tax provision in the partnership agreement wasn't always there. So, that was not the state of the art of writing partnership agreements 30 years ago. So nowadays, fast forward 15 years from 30 years ago, those investors that were trying to get out, if they had large negative capital accounts, they're stuck with the terms of the agreement they signed. And if it didn't mention exit taxes, there's no reason why they should ask anyone to pay their exit taxes for them, because that wasn't mentioned in the agreement that they signed, even though that's become the state of the art now. So that court case established that you can't just look at what is the current prevailing state of the art to establish what your agreement should say. You have to look at what did the agreement actually say that you signed. That's what that's what matters.
Right. Okay, if there are no other questions, you're welcome to log off, and we'll see you next week.